So hello students, so welcome to this particular session on MAT and the surrogate taxes. So students, here in this particular session we will be discussing across this particular area one of the most important particular topic, because in MAT students you can definitely expect an independent question on MAT, apart from the fact that they do have the tendency of asking this in the MCQ also, integrated case study mainly. But yes, an independent question of around 8 to 10 marks is always a hot favorite of the ICI. So we will be discussing that, students. Now students, my discussion so far as MAT would be concerned would be on the important key points of this particular topic, so that you are in a position to revise through the key points. First of all, students, is the applicability of MAT on the foreign company. Let's talk about first foreign company and try to discuss across what are the special particular provisions which are there for the foreign company. So students, herein, as far as the foreign company is concerned, for the purpose of the applicability is concerned, the applicability of MAT will arise only if, students, the applicability of the MAT provision will arise only if what? Only if you find that here the foreign company has got a place of business in India. The foreign company has a place of business or a permanent establishment in India. Now that is for a very good reason, students. And the reason, as we all are aware, that unless and until, as per the Companies Act, unless and until the foreign company has a place of business in India, unless and until the foreign company has a place of business in India, it is not required to, it is not required to maintain the books of accounts. And books of accounts is necessary to get the net profit, and the net profit is the base amount to calculate the book profit. So everything is interlinked. So it starts from the requirement for a foreign company to have a place of business in India or a P in India, so as to make it compulsory for them to maintain the books of accounts, and only then we will have a net profit as per the Companies Act, and only then we can talk about the book profit computation. So that is the reason why the applicability for a foreign company, so far as MAT is concerned, requires the existence of the PE or a place of business in India. At the same time, students, there is some non-applicability also, which is there in point number 4 in your chart. And if you see here point number 4 of your chart, it is very evident that in the case where when there is a presumptive income which is followed, in the case where there is a presumptive income which is followed under section 44B, double B, BBA and triple B, students, generally what happens, as you may be aware, 44B and 44 BBA, which is in respect of a shipping company and a foreign airline company respectively, in respect of these two categories, one very prominent, these two particular presumptive income provision for the shipping company and the airline company of a non-resident, these are the mandatory provisions. These are the mandatory provisions. So therefore these particular companies necessarily will have to compute the PGBP as per the normal provision under these section itself. They don't have the other option. They don't have the other option to compute the PGBP. They don't have the other option of computing the PGBP at all. Meaning thereby the other option, as we all are aware, to maintain the books and to get it audited and report a lower amount of profit, that option is not available. And that is the reason why the lawmaker would have felt that because it is already a mandatory provision, and that too the income is determined on a presumptive basis, and here also in the book profit it is nothing but a presumptive income. At the end of the day, what we get as a book profit computation is nothing but a presumptive income, and therefore they felt that if it is a clash between two presumptive income, we cannot favor one over the other. So let's probably not make the MAT provision applicable for these particular company who reports their profit, these particular foreign company who reports their profit under the normal provision under section 44B, 44BB, 44BBA and 44BBB. So that is a point. Apart from that, for the foreign company who actually undertakes the computation of book profit, for all these foreign company students, there are some important adjustment that they need to make in determining their book profit. There is an important adjustment that they need to make in determining what their book profit. And what is that adjustment? So the adjustment that they have to make in determining students their book profit is this. Be careful students here. The adjustment students that they will have to make in determining their book profit students is this. See point number 9. Now what point number 9 says over here in this context? As far as point number 9 is concerned, what they are trying to suggest is only this, that all these particular foreign companies who actually have to do the book profit computation to determine the MAT liability, in their computation of book profit, that portion of the income which under the normal provision is chargeable to a rate of tax which is lower than 15%, because MAT rate is 15%. So if they are chargeable to a rate of tax which is lower than 15%, then in that case, that portion of the amount of that portion of the income will not be a part of the book profit. That portion of the income will not form part of a book profit. So therefore, students, if any foreign company has some income in their net profit, on which as per the normal provision the rate of tax applicable is less than 15%, then that portion of the income and its corresponding expenditure will not form part of the book profit. When I say it will not form part of the book profit, it means that any profit and loss account credit item will be reduced. Any profit and loss account debit item will be added back. So that is what we say it will not form part of the book profit. And accordingly, we have to figure out which is the case where the rate of tax applicable to the foreign company in respect of a particular income is lower than 15%. Then for that, students, your search should end in section 115A. Your search should end in section 115A, wherein we have got royalty and FTS income, which is chargeable at the rate of 10% when there is no permanent establishment in India. That is point number 1. Secondly, students, even the interest income in certain cases, like the interest received by the foreign company in respect of their investment in long-term infrastructure bond, interest received from the business trust, or the interest which is received from a rupee denominated bond. So those interests are eligible for a lower rate of 5%. So that also will be excluded while determining the book profit. Now, at the same time, students, you may be aware, I'm not aware, I think because surrogate taxes, we are supposed to do it now, but still I suppose that, and I'm assuming that you may be aware of this particular point, which is about that if you remember, students, dividend income under 115A is taxable at 20%. But in one case, dividend income is taxable at 10% also. Are you aware of that point of 10%? So the 10%, students, would be the case when they are receiving the dividend from the business trust. That dividend which the business trust has received from the SPV, and the SPV, the special purpose vehicle, has opted for the alternate tax regime of 115BAA. The SPV has opted for the alternate tax regime of section 115BAA. If this is a combination which has taken place, then the dividend amount, students, will become taxable in the hands of the unit holder, but the tax rate at which it will be charged would be at 10%. Being the non-resident, will be eligible for a rate of tax at 10%. So that is a concessional rate applicable for a non-resident. So 10% would be the rate of tax on that dividend income. Which dividend income? The dividend income which the non-resident or a foreign company would have received from the REIT. That dividend which the REIT has received from the SPV, and the SPV has opted for 115BAA. In such particular case, the dividend income will be taxable in the hands of the foreign company at the rate of 10% in the normal provision. And if it is taxable at the rate of 10% in the normal provision, just now we have said that those particular income which are there in the net profit will not form part of the book profit, because the rate of tax as per the normal provision is lower than 15%, and that is what should be eliminated. So now students, just think of it. Another example if I have to give you is like 112A, long-term capital gains which is computed under section 112A. So that long-term capital gains which is computed under section 112A, even in respect of that long-term capital gain, students, we will say the same thing, which is that this long-term capital gains, because it is taxable at the rate of 10%, also will not form part of the book profit calculation. So for a foreign company, it's a blanket provision that any income of that foreign company which is chargeable to tax at the rate less than 15% in the normal provision, then those income will not form part of the book profit. So now this is for the foreign company. The question that arises is that whether such similar provision are also there for a domestic company. For the domestic company also, do we have a similar provision where the rate of tax as per the normal provision is lower than 15%? Then whether that particular income also will be excluded from the book profit calculation. Now just think of it. I just told you the example of 112A. 112A income, if it is there for the foreign company, the fact that the rate of tax is at 10%, therefore it will not form part of the book profit calculation of that foreign company. Just take an example that it is a domestic company which has got this long-term capital gains, which is chargeable under 112A at the rate of 10%. So question arises is that if the domestic company has to compute the book profit, so whether for the domestic company will this particular long-term capital gains chargeable under section 112A, will that also be excluded in computing the book profit? And the answer is no. And the answer is no. Such blanket exclusions are not available for the domestic company. In fact, for the domestic company, they have got only one exclusion where the rate as per the normal provision is less than 15%, and therefore that particular income is not forming a part of the book profit. And what is that particular case? That the case is when a domestic company, being a resident in India, they have undertaken a research and development activity in India, and thereafter the outcome of that research activity has been registered, has been patented in India, has been registered or patented in India. Therefore, that particular royalty income that they will earn out of the patent, will be charged to tax under the normal provision at the special rate of 115 BBF, and the special rate under 115 BBF is at rate of 10%. Is at the rate of 10%. Now this particular 10% being the rate, accordingly it will be charged under the normal provision. Now only this particular income does not form part of the book profit as far as a domestic company is concerned, and therefore if you see for the domestic company, point number 8, here in point number 8, students, what we have got, that any expenditure in respect of the royalty income which is accessible under 115 BBF, that expenditure if debited has to be added back in computing the book profit, and its corresponding royalty income if credited in the net profit, then in that case the same needs to be reduced in computing the book profit. So this is the only particular income of the domestic company which will require an exclusion. This is the only particular income of the domestic company which has this particular exclusion. Now apart from this one, students, let's look upon to the other particular adjustments now, key adjustments which are there so far as MAT is concerned. Now I'll do a quick particular point, and I'll also tell you how they have targeted this point in the examination. Students, if you create a reserve by whatever name which is called, if you all are creating a reserve by whatever name it has been called, then in that case, students, the reserve's creation reduces the net profit, and accordingly in that case, that reserve which has been created has to be added back. This is what is the mandate of the computation of book profit. That reserve which has been created needs to be added back. Okay, now if you create a reserve, then it is P&L account debit, and then there is a liability side reserve account in the balance sheet. There is a liability side reserve account in the balance sheet. Now, subsequently, you will try to write off that reserve account in your profit and loss account. Subsequently, you will try to write off that reserve account in your profit and loss account. So therefore, whenever you will try to write off that reserve account in your profit and loss account, then in that particular case, students, what will happen? There will be a profit and loss account credit that will take place. there would be a profit and loss account credit that will take place, and the fact that at the time when the reserve was created, already you have added your net profit to compute a book profit. So now if this reserve which has been written off and it is forming a part of your profit and loss account and thereby the net profit, then it will result into a double taxation. Then it will result into what? A double taxation. And therefore students, to in order to eliminate such double taxation, that they have said that to the extent of the reserves which has been already debited, that much of the reserves which has been written off in your profit and loss account credit side will have to be reduced, while computing your book profit, to the extent of the reserve which is already added back at the time when it was being created. That much portion of the reserve, if it has been written off in the profit and loss account, has to be added back, has to be reduced in computing the book profit. Now, I have seen couple of questions in the examination which is worth to be discussed over here. So the question, they have said that in one of the earlier year the reserve was created, but they are also telling you that in that point of time the profit and loss account was not added back with the reserve which was being created, and now in the current previous year the reserves has been written off to the profit and loss account credit side. Now in the current previous year the reserves has been written off to the profit and loss account credit side. So the question to all of you would be that whether this reserve which has been written off in the profit and loss account credit side, will that be excluded? Will that be, students, excluded in this case in computing the book profit? And the answer is no, because at the time when it was being created you have not done any additions as per the specific information in the question, and hence now that the reserves are written off in the profit and loss account credit side and it is forming a part of your net profit, you are not going to reduce it to compute a book profit. This is point number one. Point number two, students, is about the depreciation. So if supposingly, students, there is any revaluation that may have taken place, in the books of accounts, then whatever is the excess depreciation that you may have claimed, on the revalued portion of the asset, then that much portion of the excess depreciation needs to be added back in computing the book profit. This is the crux of this particular adjustment. Whatever is the excess depreciation that may have been claimed on the revalued portion of the asset, then that much portion of the excess depreciation needs to be added back in computing the book profit. Now here lies the catch, students, And what is the catch in this particular case? The catch, students, in this particular case is that when we talk about the presentation in your examination, you will have to follow this approach. If supposingly the question says that there is a revaluation that has taken place on the asset, then in this case the presentation would be like this. The presentation would be, first you please add back the entire depreciation amount, because this depreciation amount is on the revalued portion also. So please add back the entire depreciation amount, and thereafter you will reduce the depreciation as per the books but without revaluation. You will reduce the depreciation as per the books but without revaluation. So the net effect is obviously what is finally getting added back is the depreciation on the excess depreciation which has been claimed on the revalued portion of the asset. But the presentation of your ICI answer would be like, first you need to add back the entire amount of depreciation, and second would be to reduce that portion of the depreciation as per the books which is on the which is without revaluation of the asset. Rest of it is deferred tax liability, deferred tax asset. All of you are aware, any DTA and DTL if it is created, kindly make the necessary adjustment so as to bring it back before the DTA and DTL provision. Thereafter, students, the next particular item of discussion is this exempt income. Now students, this exempt income, as we all are aware, as far as the exempt income is concerned, students, always be very careful about the exempt income. If your net profit as per the Companies Act has certain exempt income, then that portion of the exempt income, students, exempt income, students, will not form part of the book profit calculation. So it means you need to reduce it if it is in the profit and loss account credit side. Similarly, if there is any corresponding expenditure in relation to such exempt income, then that corresponding expenditure needs to be added back in computing your book profit. This is a clear-cut position, students. Always keep that in mind. This is a clear-cut position, so that the logic of the MAT is never to tax the exempt income. What they intended is to ensure that under the normal provision where the SSC is privileged to claim the profit link deduction, the deductions like 35 AD, those big heavyweight deductions are something not considered in computing the book profit, because we start with the net profit as per the Companies Act as a base amount, and all we know, as far as net profit of the Companies Act is concerned, there is no concept of a profit link deduction which are being given, or even the 35 AD deduction which is on the capex. You don't get in the net profit computation as per the Companies Act a outright deduction of the capex. What you only get is the depreciation allowance on the capex, but not an outright deduction of the capex. So therefore, by using the base of net profit as per the Companies Act, they have inherently eliminated any influence of the profit link deduction or the investment link deduction which is governed under the normal provision of the Act. But the intention was never to tax the exempt income which may be a part of your net profit as per the Companies Act, and therefore those particular exempt income and its corresponding expenditure also needs to be kept out of the purview of book profit, and accordingly the necessary adjustment needs to be made. Now on this particular part, students, there is one important point, which is point number 7. So point number 7 would be a case where supposingly a company is a partner in a partnership firm, and if a company is a partner in a partnership firm, then the share of profit received by the company, will qualify for an exemption under section 10(2)(a), and accordingly in respect of that share of profit, the same will not form part of the book profit. Because it is exempt under section 10(2)(a). But just consider this: if that company is a member of an AOP, the AOP profit will be charged to tax at MMR. And what happens? The share of profit which is received by the member, that is it exempt under section 10? Answer is no. In fact, students, as per section 86, in such a case, the share of profit received by the member where the AOP is taxed at MMR, as per section 86, such share of profit is not going to be a part of your total income. So here it will not be a part of your total income, because the AOP is being taxed at MMR, which is 42.744%. MMR for the AOP. But the fact that this particular exclusion in the total income of the member is under section 86, not under section 10, therefore it does not avail, it does not become eligible for that adjustment in point number 6. And that is the reason why, students, they have to specifically accommodate this particular adjustment for a company being a member of an AOP where the AOP is already taxed under at MMR. Then the share of profit received by the member from this particular AOP will not form part of the book profit, just to have a uniformity in the adjustment, the way we do the adjustment for the share of profit received by the company being the partner of a partnership firm. So same is the concept that is extended to the share of profit received by a company being a member of an AOP. So that is how the things has to be looked upon. Now comes the Ind AS adjustment, students. Now let's have a look towards the Ind AS adjustment. This is an important one. Now, students, as we all are aware, what happens so far as the Ind AS adjustments are concerned. So in the context of an Ind AS adjustment, students, I think all of you are aware of it. So students, what happens in the case of an Ind AS adjustment? I think all of you should be aware of it. That primarily in the case of the company on which the Ind AS is applicable, So always keep in mind, students, in the examination you will be getting the two things. One is the OCI statement. The OCI statement in two parts. OCI statement in two parts, students. And what is that in this context? Herein. So students, in the OCI, when you will be given two OCI, one OCI would be referred as OCI which forms part of the profit and loss account. So one of the OCI would be referred as what? As forming a part of your profit and loss account. So that whatever is the content which is given in that particular statement, please don't do anything of that, because it is already forming a part of a profit and loss account. It is the second OCI statement which they say which will not be reclassified in the profit and loss account. On that OCI statement only we need to do our working. So again I'm repeating, there would be two OCI statement that they will mention. One OCI statement which is going to be which is reclassified in the profit and loss account. Absolutely don't worry, whatever are the debits and credits, don't do anything, it is already captured. But the OCI which is not reclassified in the profit and loss account, only in respect of that, students, what you need to do is just that you will ensure students to do the selected adjustment as what we are going to discuss it now. So students, what they say here in this case, they start with saying that in the OCI which is not reclassified in the profit and loss account, primarily whatever is the credit of this OCI statement, you have to add those credits in computing the book profit, and whatever are the debits of that statement, which is not reclassified in the profit and loss account, whatever are the debits in that statement, you have to reduce it. But except for the following items. So in respect of the following items, those particular adjustment of credit will or debit, as the case may be, will not be made. And which are the items that we are talking about it, students? Let's have a look. The item, students, that we are talking about it in this context is about what? Is about the case where the assets which are revalued as per the Ind AS, those assets which are revalued as per the Ind AS, those, if at all there is any corresponding credit or debit, then the same will not be captured in your book profit, meaning thereby you are supposed to ignore them. Please don't do any adjustment in respect of those assets. Similarly, in respect of any revaluation which is done as per Ind AS on the equity instrument investment, which you hold, then again in respect of that particular equity instrument investment, any revaluation which is done as per Ind AS, on that particular revaluation as well, you are not supposed to do any adjustment of the credit or debit, as the case may be. No adjustment will be done. Simply ignore it. So if you see here, the note part is a critical one. No add or less of the item shall be made in respect of revaluation of asset or gain or loss from investment in equity instrument at designated fair value. So these are the notional gain and notional loss, unless the recognition of the asset or the equity instrument investment will only be made when these are actually disposed of, so that the real profit or the real loss arising on the disposal of these asset or these investment only will be captured in computing your book profit. Is the intention that they have highlighted upon. So this is your first adjustment. So there are in Ind AS, students, there are total 4 adjustments that you should be very careful about it. First is this one, that in respect of the assets and the equity instrument investment, you will not be doing any adjustment relating to the notional gain or notional loss arising out of the fair value basis of valuation as per Ind AS. No such recognition will be made to determine the book profit. The recognition would be made only at the time of disposal, where the real profit and the real loss is what will be captured in the book profit computation. This is your adjustment number 1. The second adjustment, students, that you can see is in respect of demerger. As we all are aware, students, that the demerger is always tax neutral. The demerger, students, as you all are aware, is always tax neutral demerger. And if it is a tax neutral demerger, because if you know in section 47, as per the normal provision, the demerger is not subject to any taxable transfer. It is not subject to any charge of capital gains. So the fact that there is whatever is the notional gain or notional loss arising on the demerger, the same is not chargeable under the normal provision. Similar is the approach that we have to follow in computing the book profit, that any notional gain or notional loss arising at the time of demerger will not form part of the book profit calculation. Will not form part of the book profit calculation. Now, apart from this, students, the next one is about this one. This is a big one. Point number 3. Third point. Students, in the first year, when the year of convergence, that is the year of convergence, the first year, which is the year of convergence, what happens is this, that in the year of convergence, students, from the historical cost, you convert yourself into fair value. So obviously there is a huge transition that will take place. So therefore, this transition that will take place will be referred as a transition amount. The difference between the historical cost and the fair value, that at the time of convergence would be referred as a transition amount. The first time adoption of Ind AS, at that point of time, there will be a transition amount. Now, in the transition amount, again, they have said that these items should not be a part of the transition amount. So there are two reliefs that they have given to you. The relief number 1 is that the big items are not kept as a part of the transition amount in computing your book profit. The big items are kept out. Which are those big items? Let's have a look. Which are kept out for computing the transition amount? Let's have a look. So the amount in the other equity, transition amount means the amount which is adjusted in other equity excluding, this is important, students, excluding capital reserve and security premium amount. In the examination, they will give you about this one, that the transition amount comprises of the capital reserve or the share premium. If it comprises about the capital, this particular capital reserve and the share premium, so kindly ensure to exclude the same in computing this transition amount. Apart from that, what else? Apart from that, the same item that we have discussed just now, which is the asset revaluation from the transition amount or from the historical to the fair value. So whatever we have discussed in point number 1, same is also over here, that you will not recognize the notional gain or notional loss at the year of conversion in respect of the asset and in respect of the investment in equity instrument. So no notional gain or notional loss would be recognized at the time of convergence, because we have just now have seen in point number 1 that their recognition in respect of these assets or the recognition in respect of these investment will only be made on a real gain or a real loss basis, and that is the reason why you will not recognize, you will never recognize the notional gain or notional loss either at the time of convergence or any point of time thereafter. Either at time of conversion or at any point of time thereafter. The third one, students, apart from that, students, if you can see, just also see this other exclusions in the transition amount, other exclusions, investment that you have it in subsidiary or your joint venture. So any investment that you may have in the subsidiary or the joint venture at the time of convergence, no notional gain or notional loss needs to be considered in determining the transition amount. And the last one is about the translation difference of a foreign operation. So if you may have a foreign branch, so any translation difference that will take place at the time of conversions, even that will not form part of your transition amount. So therefore, this is the first thing, which is the relief which has been given to you, that in the transition amount, these big ticket size item will not be captured in the transition amount. That is point number 1. And the second major relief which has been given is that the transition amount that will be captured in the book profit will not be captured in one go. It will be captured in 1/5, which means that 1/5 of the net transition amount that you have determined just now, only the 1/5 will be recognized. Now this 1/5 can be either you have to add to the book profit or you have to reduce from the book profit depending upon the transition amount is heavier on the credit side or the transition amount is heavier on the debit side. If it is heavier on the credit side, then you need to add 1/5 every year. If it is heavier on the debit side, then you need to reduce 1/5 every year. That is the point that you should always keep in mind. And the last of the Ind AS adjustment is in respect of the foreign operations. So far as the foreign operations students is concerned, what they have said is this, that foreign operations, like for example branch, in respect of the branch, any adjustment, if any adjustment will be done in the book profit computation only when the foreign branch has been disposed of. Only when the foreign branch has been disposed of. So always keep in mind these 4 items of adjustment for as far as Ind AS is concerned. The first item is not to include the asset revaluation or the equity investment revaluation unless they are actually disposed of. Second one is about the demerger. In the case of a demerger, because it's a tax neutral demerger, students, therefore notional gain or notional loss arising at the time of demerger will not be recognized in computing the book profit. Third is about the computation of transition amount, wherein the big ticket size items are being kept out in the transition amount calculation, namely capital reserve, share premium, thereafter those items which we have just discussed, thereafter the investment in the subsidiaries and the JV, and the transition difference of a foreign operations. All these will not be a part of your transition amount, and accordingly students, if they are not forming a part of your transition amount, then in that particular case students, you just need to simply take what students, 1/5 in this case. 1/5 either add or less depending upon whether credit side is heavier, then do add it. If the debit side is heavier, then 1/5 you have to reduce it for the 5 years period. Now students, the last part that you can see is about the independent add and independent less. Now, what are the independent add and independent less, students? Let's have a look to that particular part first. Provision for uncertain liabilities. So, if in the computation of the net profit as per the Companies Act, if there is any provision which are meant for the uncertain liabilities, then what they say, you need to add it back. You need to add it back. Now, just tell me one thing, students. What you do of the provision for uncertain liability in computing the total income as per the normal provision? Even in that you add it back, because then there is an ICDS 10 which says that the contingent liabilities will be recognized. The contingent liabilities, students, will never be recognized, meaning thereby you will not be getting a deduction. So there also we don't recognize it at all. The second point is about the provision for losses of subsidiary company. Obviously, students, in the accounting, you may try to book a loss of your subsidiary company. You may debit the loss of the subsidiary company, but the income tax law has its core principle which says that only the person who has incurred the loss, that person only would be eligible to do the adjustments. And accordingly, any provision for loss of subsidiary company, if it is debited in the profit and loss account, then the same needs to be added back in computing the book profit. By the way, students, what you do about this adjustment while you compute the PGBP or the total income as per the normal provision, again there also you add it back, because the loss of subsidiary company, it is a subsidiary company which will take that particular credit, not the holding company. So same thing happens over there. The third one is an important one and quite interesting one, which is about the income tax paid or payable. Students, income tax paid or payable. Now they have given you, they have given you income tax includes the following. By the way, students, just keep in mind, if there is any foreign taxes, students, if there is any foreign taxes, even that foreign tax is also a part of your income tax. So again, any foreign tax which is debited to the profit and loss account also will not form part of the book profit. That is point. Secondly, in the computation of book profit, income tax, they have defined that it will not include the dividend distribution tax. Any case it is not there. The second one is an important one, students. Interest under the Act. Now, generally, we always think like this. Interest under the Act, we think of 234 A, B, and C, and only that interest is what we consider ourselves for the purpose of adjustment. But be careful, supposingly they give it to you that the company was being charged to interest on late payment of TDS, say under section 201. So therefore, whether the late payment of TD, the interest which is charged on late payment of TDS, if it is debited in computing the net profit, if it is debited in computing the net profit, so whether you are going to add it back, answer is yes. Why? Because this is an interest under the act, interest under the act, and therefore this interest also needs to be added back. Students, how they read? They read this item as interest on income tax. No, no, it is not interest on income tax. Any interest which is charged under the act and it is debited to the profit and loss account, then the same needs to be added back while computing the book profit. Just keep that in mind. Surcharge and the cess, that is fine, that was added any case. Dividend paid or proposed. Student, the next item is dividend paid or proposed to be added back. What you do in the normal provision, even in the normal provision, you add it back. By the way, just a recollected at one point. Penalty for infraction of law if it is debited to the profit and loss account. Penalty for infraction of law if it is debited to the profit and loss account, then what you will do under the normal provision? Then what you do under the normal provision? Do you add it back? Answer is yes, because this is specifically disallowed. What you will do in computing the book profit? Will you add it back? Answer is no. There is no such adjustment referred in 115JB. There is no such adjustment referred in 115JB. So therefore, no adjustment will be made. Let that remain as it is in computing the book profit. By the way, students, I just forgot one important point, and that point was, students, in one of the examination, the Ind AS, students, what they have said was like this. Be careful. Huh? They have said that the profit computed as per 115JB subsection 2 is rupees say 50 lakhs. And thereafter, students, they have given you the Ind AS adjustments. Now, students could not understand that if the profit is already computed under 115JB subsection 2, then why is it that they are giving you the Ind AS adjustment? Because the Ind AS adjustments are not under section 115JB subsection 2. The Ind AS adjustments are under 2A to 2D. So 2A to 2D is where the Ind AS adjustment lies. So if supposingly they give it to you that the book profit as per 115JB subsection 2 is rupees 50 lakhs. So it implies that this is not then after taking into account 115JB 2A to 2D, which is all about the Ind AS adjustment, which means that those adjustment, those items which are separately highlighted in the question needs to be taken into account as we have discussed just now. Because what has been given is only the book profit. So whatever else is there in the book profit computation except for the Ind AS concept which we have discussed just now, whatever else is there in the book profit concept has already been captured. And now by giving you the Ind AS data, they only want to focus your thoughts only in that Ind AS data. So just keep that particular point in mind. Okay. Now apart from that, students, last is the provision for diminution in the value of asset. Now, in the case of provision for diminution in the value of the asset, the classic example is the provision for bad debts. The provision for bad and doubtful debts. So, for a provision for a bad and doubtful debt, students, we all know this is the provision in the diminution in the value of the asset. So, accordingly, what we need to do in computing the book profit, we need to add it back. What about the total income? What about the PGBP? If there is a provision for bad and doubtful debt, students, under the head PGBP, do you get a deduction of the provision for bad debts? Answer is no. You get deduction only of the actual write-off of the bad debts and not merely on the basis of the provision. So only the actual write-off of the bad debts is what is allowed to you as a deduction and not merely the provision. Be careful. Provision for bad and doubtful debts is allowed only in respect of that banking company and the NBFCs and all. Only for them that the provision for bad and doubtful debts are allowed as deduction, but not for the others. Just keep this particular concept in mind. So therefore, coming back to point number 5, the example would be that provision for bad and doubtful debts, if it is debited to the profit and loss account, then the same needs to be added back. Students, what about provision for gratuity? Provision for gratuity. Whether the provision for gratuity, will it be considered similarly? Whether the provision for gratuity, will that be considered similarly as a provision for diminution in the value of the asset? No. Gratuity provision is not equivalent to the provision for diminution in the value of the asset. And therefore, if there is a provision for gratuity which is debited in the profit and loss account, then in computing the book profit, no other adjustment needs to be done. No further adjustment needs to be done. But what about the normal provision? If the provision for gratuity is, if it is debited in the profit and loss account, then what you will do in the normal provision? You are going to add it back. You are going to add it back, students, because under the income tax law, under PGBP 40 capital A specifically disallows the provision for gratuity. And the provision for gratuity, if you want to claim a deduction, then you need to deposit the money in the approved gratuity fund and claim the deduction under section 3615. So either you deposit this particular gratuity amount in the approved gratuity fund and claim the deduction under section 3615, or better, you directly pay this money of gratuity to the employee. And if you directly pay this money directly to the employee, then the deduction will be available to you under section 37(1), because fund contribution, approved gratuity fund contribution, you get deduction under section 3615, whereas paying directly to the employee, you get deduction under section 37(1). Somebody will think of it that, sir, then it is better to pay directly to the employee to claim a deduction under 37(1). No, students, it is better to put the money in the fund, because it is only the money which is deposited in the approved fund has the grace period of 43B, which is up to the due date of filing of the return of income. If you can deposit the money in the gratuity fund, you can claim the deduction in the same year. But supposingly, if you would have paid directly the amount of gratuity to the employee, and maybe the amount is paid in the next year it is paid, although it is paid in the next year, but before the due date of filing of the ROI, that particular provision for gratuity amount, will not that particular gratuity which is actually paid to the employee will not be allowed to you as a deduction in the current year. The deduction, if any, will be given to you only in the next year. So that is a difference between paying the gratuity directly to the employee versus paying the gratuity to the fund. This I am talking only about the normal provision, because here, as far as book profit computation is concerned, if it is a provision for gratuity, then definitely there is no requirement of any further adjustment to be made in computing the book profit. Students, apart from that, this is about the independent deletions. In the independent deletion, the first and the foremost thing is that the profit of a sick company, students, the profit of a sick company will not be subject to a MAT. A company is considered to be a sick company till the time, students, its net worth is less than the accumulated losses. Its net worth is less than its accumulated losses. Till that particular point of time, it is considered as a sick company, and accordingly till that point of time there is no MAT. But the moment the net worth is equal to or greater than the accumulated losses of the company, then in that case it is no longer considered as a sick company, and accordingly in that particular case the MAT provision would become applicable. Now students, point number 2 which you can see over here is about the brought forward loss or unabsorbed depreciation. Now this brought forward loss or unabsorbed depreciation, students, as per the books, students, now only one of the two will be allowed to you as a deduction. As per the books. Now both of them will not be allowed to you as a deduction, but the only exception to this is that if supposingly the company has already filed for IBC, or the company or that company management is put up by the central government as per the Companies Act, some section 241 is there, then only in respect of those company, the company which has filed for IBC and the company where the board is appointed by the central government, only for those company that both the deduction of brought forward loss as well as the unabsorbed depreciation as per the books, not as per the income tax law, as per the books is allowed to you as deduction. Both then will be allowed. Otherwise, it will be only one. And such a sorry picture it would be that supposingly, students, you have only one item and the other item is nil. then you will never get the reduction of that first item, which has got some value, because lower of the following two only will qualify as reduction. So if your lower amount is nil, then nil is what will qualify. So the other item may not be getting the reduction at all. Now students, here I will be telling you one very important point which you have to keep in mind in the examination. The two times the presentation has changed. Two times students the presentation has changed in the question. The students were wondering why is it that this is a different treatment. I'll tell you why it is. But before that students, the last point is about the profit from tonnage tax scheme. So the profit from tonnage tax, the domestic company students, they already have a presumptive basis of determining the PGBP as per the net tonnage of the vessel, as per the net tonnage of the vessel. So only for, okay students, by the way, tonnage tax scheme, I am giving you one link in the description box. Do ensure to go through that particular link, because that is a case study analysis discussion which is of the ICI case study, and I consider this to be one of the most likely question in your examination, because it is something which is covered in the ICI, the link of which I am going to give it to you in the description box. So therefore profit from tonnage tax scheme also will not be subject to VAT, because here also they are doing it on a presumptive basis. So why is it that then again we need to compute it as per the book profit computation? Okay. So students, over here if you all will see and finally conclude, what was the question which I was talking about, it was just that in that particular question, ICI has, one question was the ICI has the brought forward business loss and UAD of 2 years as per the books of 2 years. And obviously, I think brought forward business loss as per the books was lower as compared to the UAD in both the years. Okay. Now, as per whatever data that they have given. Now, below this, they have given you one statement or a sentence stating that in those respective years, in those respective years, one of the that lower, which was brought for business loss as per the books, that was being adjusted. That was being adjusted. Okay, so that was already being adjusted because that was a lower amount. So accordingly, that was being adjusted. And you are also given in the question that the company in the current year has gone for the IBC. The company in the current year has gone for the IBC. So accordingly, if the company in the current year has gone for the IBC, it means what? The unabsorbed depreciation as per the books, which is left out up till now for that last 2 years. So that is what will now be eligible for deduction. So they have claimed a deduction in that particular question. In the another question of the examination again, they have given again the 2 years data of brought forward business loss as per the books and unabsorbed depreciation as per the books. Again, assuming that brought forward business loss as per the books was lower in both the years. But this statement was not there. Which statement? That in those years, primarily, the brought forward business loss as per the books was reduced. And they are giving it to you that in the current year, the company has gone for the IBC. In this solution, they have reduced both the amounts. Brought forward business loss as well as UAD for both the years, they have reduced it in the solution. Now, what would be the approach that the IC has taken in this particular question was, they would have assumed that because that they have given you the data of the brought forward business loss and the unabsorbed depreciation as per the books for those 2 years, it therefore imply that this much amount of the brought forward business loss as per the books and this much amount of the unabsorbed depreciation as per the books is yet to be adjusted, is what they are trying to convey a message to you. Because that statement, unlike in the first particular question, that statement was not there in this question, and therefore what they are trying to say to you is that this much of amount of the brought forward loss and the unabsorbed depreciation as per the books is yet to be adjusted, and because it is yet to be adjusted, therefore they have reduced in this solution both the amounts. And that exactly is the point, students. So this is what I thought just to discuss with you about this kind of a question, that this is how you need to execute your solutions. Is that clear to all of you, students? So now students, we'll proceed further. Now last point, surcharge limit, students. Please be careful. The surcharge here would be on the basis of the book profit threshold. As you all know, for domestic company and the foreign company, the threshold is 1 crore above and 10 crores above. That is how the threshold begins for domestic company and the foreign company. So the same threshold would be considered now from the perspective of the book profit. Okay, from the perspective of the book profit is what the threshold would be considered. So that is one thing that you should keep in mind. Second and equally important point is that students, if supposingly in the book profit computation there is any special income, so is it that in the special income will be charged at the special rate of tax and the balance book profit would be taxed at the rate of 15%? Is that the case? Never do that. Huh? There is only singular rate here for MAT calculation and there for the AMT calculation. In the AMT calculation also the similar concept is applicable. Okay, even though there is maybe a special income in that adjusted total income, still the 18.5% of the AMT rate is what is to be applied. Here also 15% of the MAT rate is what to be applied on the book profit calculation. That is one thing that you should keep in mind. With that, students, we are done with this part, and now there is some MAT credit, as you all are aware, that 15 years. So if there is a case for MAT in the current year, the liability is as per the MAT and not as per the normal provision, the tax provision, then there is a MAT credit that will emerge, and that MAT credit, students, can be adjusted in the year in which year the MAT credit could be adjusted, students. The MAT credit, students, could be adjusted in the year in which the tax as per the normal provision, students, is higher as compared to the MAT. In that very year only the MAT credit would be adjusted, but be careful, the maximum adjustment of the MAT credit would be to the extent of the liability in the year to be minimum alternate tax. So therefore, it may so happen that you may have a lot of MAT credit, but the maximum that you can adjust in that very year would be only that amount, so that your overall liability in that year is at least of minimum alternate tax. So that is what you should just keep in mind, and that is what is all about the concept of MAT credit. Now there is a concept of MAT credit and the foreign tax credit. Before going to this particular provision, this is unique thing, students, yet to be tested. Just keep in mind, you never know, it can be asked here, and though if it is asked, nobody will be in a position to do this. So supposingly, students, the tax payable under the normal provision is 1. So as per the normal provision, the tax is only 1, whereas under MAT it is 50. So how much is the MAT credit up till now? 49. With MAT is 50, normal is only 1, so the MAT credit is 49. Now the foreign tax credit is how much? 45. The foreign tax credit, students, over here is how much? 45. Okay, so that is what they've given you. The tax paid in the foreign country is how much? 45. Now see the statement what they've given here in this case. Be careful about the way they have used the language over here. So the language is, where the amount of tax credit in respect of income tax paid in any country, I have just written here is foreign tax credit. So foreign tax amount. So where the amount of tax credit in respect of income tax paid in the foreign country outside India allowed against the MAT liability as per 115 JB. So allowed against the MAT liability, how much is the foreign tax that can be allowed against the MAT liability? So your MAT liability is 50. So the entire 45 can be adjusted. Entire 45 of the foreign tax can be adjusted against the MAT liability. If 45, which is the foreign tax, which can be adjusted or it can be allowed against the MAT tax liability, so therefore this is 45 rupees. So if 45 exceed what, students? The amount of such tax credit which is admissible against the normal tax payable. So how much is the foreign tax that can be adjusted against the normal tax? Your normal tax is 1, foreign tax is 45. How much maximum you can adjust? Only 1. Only 1 you can adjust. So now you tell me, in this case, 45 of the foreign tax can be adjusted against the MAT, whereas only 1 of the foreign tax can be adjusted against the normal tax liability. So therefore, how much is the excess now? In this case, students, how much is the excess? Then such excess, students, excess is 44. Such excess amount in the MAT credit is 49. MAT credit is 49. So the excess of the above, which is 44, so 44 amount will get lapsed. 44, which is the excess of the foreign tax adjusted against the MAT versus the foreign tax adjusted against the normal tax. So therefore, the excess amount, which is 44, in the MAT credit of 49 will get lapsed. So if that be the case, how much is the balance MAT credit which is left? It is only 5. So only 5 is what, students, only 5 is what will be allowed to be carried forward in this case. So students, this is a surcharge rate for the MAT. Domestic company, as you all know, as I was telling you, more than 1 crore it is 7%, more than 10 crores it is 12%. For a domestic company, and for the foreign company it is 2 and 5. 1 crore more than that it is 1 crore and it is 2%, and for more than 10 crores it is 5%. I'm telling you and I'm repeating this point again to all of you students, and that is about the fact that, students, herein be careful. Herein all of you students will be careful in this case. In this particular context, students, you can see it very clearly and very well that this particular percentage which is being given to you, 7%, 12%, 2% and 5% respectively, these percentage, students, which has been given to all of you primarily, this is the same percentage which is also applicable for these domestic company and foreign company when the normal income tax liability has to be calculated, isn't it? So same percentage is also applicable over there as well. Now students, the last particular part is the MAT and the penalty. Students, what happens is this, that in the underreporting of 270A there is this particular special point. And what is that? Let me in fact explain to all of you this point. So in the underreporting, students, you can easily see there is a possibility that there is an underreporting on both the cases. That is, what in the total income also there is an underreporting, and while the book profit was computed, in that also there is an underreporting which has been found. If that is the case, students, then the 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 underreporting that will be considered would be A minus B plus C minus D. That is the underreporting that will be considered. What is A over here, students, is nothing but the the total income which has been assessed, the total income which has been assessed under the income tax law, and B by the AO, the total income which has been assessed under one, say 143, and B, students, is that the total income that would have been chargeable without the underreporting, So therefore, technically speaking, A minus B, students, A minus B is nothing but the underreporting in the total income, and C minus D is nothing but the underreporting in the book profit. Whereas C is the book profit which is assessed by the AO under 143, and D is the book profit without taking into account the underreporting. So therefore, the difference of C minus D is nothing but the underreporting in the book profit. So that two has to be added together, and that will be the total underreporting made by the company, and on which you will apply the tax and consequently the penalty amount. Now here, students, one caution that they have given to you is this, that you should not do the double counting. In this last line, what they are trying to tell you is that there should not be a double counting. Double counting means, say for example, provision for contingent liability is added in both the cases. uh, is added in both the cases. So say for example, if there is a provision for contingent liability which is considered as an underreporting, and it is already captured in A minus B, which is in the total income side, then the same provision for contingent liability again will not be considered as an underreporting while calculating C minus D. So C will be the book profit which is assessed by the AO, say under section 143. And while you talk about D, which is the book profit without underreporting, so therefore the fact that this provision for contingent liability has been considered as an underreporting over there, then the same provision for contingent liability will not be considered as an underreporting over here. So the D will include even the provision for contingent liability, because this will not be considered as an underreporting. For the reason which I have already explained to all of you. So this is what would be the scenario in this context, and that exactly how it happens in this case. So students, we are done with this topic. Now with that, we go to our next topic, which is surrogate taxes. So surrogate taxes, students, is the topic. Now this surrogate taxes, students, the way we have seen in the recent past, this topic is completely now has become an MCQ kind of a topic. This topic, students, has completely become an MCQ or integrated case study. That is a kind of the coverage which they find it in the we find it in the question and in the examination also. So this is the sort of a coverage, students, that we all find it in the question. So let's have a look towards this particular point so far as the surrogate taxes are concerned. Students, let's have a look in this context. Surrogate taxes, students. It is chart number 94. Chart number 94, students. The first one, students, over here is about the buyback tax, 115 QA. So in the case of the buyback tax, students, first of all, you should always understand that the buyback tax is applicable only in respect of whom? Only in respect of a domestic company. So it is only the domestic company which is going to be subject to the buyback tax. Whether the domestic company is a listed company or unlisted company doesn't matter, but whenever it will do the buyback of its own share, then this domestic company will have the liability to pay a distribution tax on the income which it has distributed to its shareholders. On the income which it has distributed to whom? To its shareholders. So therefore, these domestic company, students, will have the liability to pay for this particular buyback tax, and that is what this section is all about. So therefore, first, the entire focus over here. Now, by the way, at what rate the distribution tax has to be paid by the company? It is at the rate of 23.296%, which is effectively 20% is a base rate plus flat surcharge of, I think, 12%, and 4% is HEC. So effectively, if you see, it is 23.296%. 20 plus 12 plus 4. 20 plus 12 plus 4 is the effective rate that needs to be considered over here. So this is how it has to be considered in this context. Now, while you calculate the income, students, see, income is that of the shareholder. For the shareholder, the buyback is of their shares are just like a case of a capital gains. Well, we talk about income, just think of the shareholder point of view. When the shareholder will have to calculate the income, how they would have calculated the income, the full value of consideration, that is nothing but the money that they would have received on the buyback of the shares. So that is the full value of consideration for them. And the entire catch is about the cost of acquisition, the cost of acquisition of the shares. So the company which is calculating the income of the shareholder, for them it is easy to know what would be the full value of consideration. It is nothing but the amount that it has distributed to the shareholder. But the challenge for the company is to know what would be the cost of acquisition. So here, students, the cost of acquisition is what is that they have mentioned in the rules. So we are going to do this particular statement in respect of the cost of acquisition, and on that basis we are going to wrap it up, this cost of acquisition exercise. What would be the cost of acquisition that would be reduced from the consideration which the shareholder has received from the company at the time of buyback? This cost of acquisition, therefore, is what we need to analyze in this particular context. So let's have a look to this cost of acquisition, students, quickly. Now, students, if you see over here, let's take one by one. I'll go with this particular proposition first about the shares which have been bought back. Earlier it was a debenture or it was a preference shares. So the debentures I have acquired originally or a preference shares I have acquired originally. Now subsequently it got converted into an equity shares. So therefore, as you all are aware, on the conversion of debentures into equity or conversion of preference shares into equity, it is not a taxable transfer, and therefore there is no capital gains tax on such conversion. And if subsequently the shares were sold, then what is the cost of acquisition? The cost of acquisition will be the cost of the debenture or the cost of the preference shares, as the case may be. So that is what will become the cost of acquisition. And accordingly, if the company is doing the buyback of the equity shares, which originally was held in the form of debenture or in the form of preference shares, then it is the cost of debentures and the cost of preference shares that needs to be considered to be reduced from the money which the shareholder has received from the buyback, and on the net income 23.296% is what would be applicable. Apart from that, students, if it is a bonus shares, then obviously the cost of acquisition is nil. For the bonus shares, the cost of acquisition is nil, and that is how this particular income would be determined. Thereafter, students, if you see over here, ESOP. Let's look upon to the ESOP case. Students, let me take you an example wherein I, being the employee of the company, I got the shares through ESOP scheme at the face value of rupees 10, whereas the fair market value as on that day was rupees 30. The fair market value as on that day was rupees 30. So the difference between the fair market value and the face value which I've paid for, the difference between the fair market value and the face value which I've paid for, that difference is known as the perquisite. And that perquisite, is it taxable in under the head salary? And the answer is yes. So the difference is a perquisite which will be taxable under the head salary. That is already given. Now going further, students, over here, subsequently if I sell the shares for say rupees 100. So then what would be the cost of acquisition of that particular share? It will be the fair market value, which is rupees 30. Why fair market value is taken as 30? Because see, 10 any case I have paid, and on the 20 rupees, I've already borne the incidence of tax under the salary. So therefore 10 is what I have paid, and on 20 is the value on which I have already have borne the incidence of tax. So 10 plus 20 is 30, and therefore it is a fair market value which ultimately becomes the cost of acquisition, and from that particular cost of acquisition, the amount that you have received at the time of buyback is what will be considered for comparison, and the difference on the difference, which is the income of the shareholder, on that difference 23.296% is what would be applied for the purpose of calculating the distribution tax. This is for the ESOP scheme, students. This is for the ESOP scheme. Now the next category, students, is that of the, if supposingly I was originally the shareholder of the amalgamating company, and subsequently after the amalgamation I'm receiving the shares of the amalgamated company. You already know, not a taxable transfer under 47. Okay, so subsequently when I'm selling the shares of the amalgamated company, the cost of acquisition of the shares of the amalgamated company would be the cost of acquisition of the shares of the amalgamating company. So same way here also, supposingly the buyback has taken place of the shares of the amalgamated company, then the company will be reducing the consideration that it has paid to the shareholder of such amalgamated company. They will reduce from the consideration that it has paid, from what, from this particular amount. Which is that amount, students? The 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 cost of the shares acquired by the shareholder of the amalgamated company, that is the consideration that they will reduce it, and in the net income they will apply the buyback tax of 23.296%. Apart from that, students, in the case of a demerger, students, as you all are aware, earlier I was the originally I am the shareholder of the Tata Sons, but subsequently of the demerger that has taken place of TCS from Tata Sons, now I am holding the shares of both TCS as well as the Tata Sons. So therefore, what if tomorrow there is a buyback of TCS that has taken place, or what if tomorrow the buyback of Tata Sons that has taken place? So you will have to then calculate the cost of the shares of this TCS and the cost of the shares of this Tata Sons. How do you calculate the cost? So when you have to calculate the cost, students, then in that particular case, as far as the TCS is concerned, there is a formula, and the formula is the original cost of the shares which I have had for Tata Sons, that is the original cost, into multiplied by the book value of the asset which is transferred, the book value of the asset which has been transferred, divided by the net worth of the demerged company. So that proportion of the book value of the asset transferred upon the net worth of the demerged company, that proportion would be applied to the cost of acquisition of the original shares. So that proportion applied on the cost of acquisition of the original shares will give you the pro rata amount, will give you, students, what? The pro rata amount. And of that particular pro rata amount, students, I will say that this will fetch you finally, students. This will fetch you finally what? The cost of the shares of the resulting company. And once you get the cost of the shares of the resulting company, the cost of the old company now will be what? The balance amount. And what is the balance amount? The original cost minus the cost of the shares of the resulting company which you have determined as per the formula. So the difference, the balance amount, will then be considered as the cost of the shares of the Tata Sons. So if tomorrow any particular company's buyback will happen, then what will be reduced from the consideration which is paid by the company? What will be reduced? Will be this computed cost that you have done it through this particular formula. That is what will be reduced, and the net amount will be referred to be the income arising out of the income which is arising out of this particular demerger. The income which is arising out of this particular demerger. And that is exactly what the situation is in this regard. After this, students, once the demerger has been dealt with it, students, thereafter the first one, if you can see over here, the shares which are being issued on the subscription, the shares which are being issued on the subscription, students. So obviously this is the general case wherein I have taken the shares through the IPO route, and if I have taken the shares through the IPO route, students, then obviously whatever the amount that I have paid to the company at the time of IPO, which includes also the share premium, so that is the amount that will be considered as my cost, and this is what would be reduced from the amount which I received from at the time of buyback, and the net is my income, and on that income 23.296%. Now friends, even this other provisions is important in this context. Even this other provision is important in this context, friends, and this is about the interest liability. So far as the interest is concerned, see, by when you need to pay the buyback tax, this is not your normal income tax, for which there is an advanced tax concept, for which there is also a self-assessment tax, and thereafter the interest of 234 ABC follows. So this is not like your income tax, this is an additional tax, and therefore when this additional tax the company needs to pay, they need to make the payment, students, within 14 days from the date when they made the payment to the shareholder. When they made the payment to whom? To the shareholder. So within 14 days from that particular date, they need to make the payment to the government for this additional tax. If there is a delay beyond 14 days, then the interest will be calculated from the date after the expiry of 14 days, from the date after the expiry of this 14 days period. So therefore the interest will be calculated from that particular date till the date the amount is paid to the government, till the date the amount is paid to the government. And so therefore the month calculation will begin from the day following the day after the expiry of 14 days. From that day the month calculation will be done, and accordingly, students, in this case the rate of interest that will be charged on the delay in the payment of the buyback tax to the government would be at the rate of 1% per month or part thereof. 1% per month or part thereof, students, is the kind of the rate of interest that would be applied. Just keep that in mind. The next, students, is the securitization trust. Now in the securitization trust, students, there is a complete pass through. What does this complete pass through mean, students? It means is that the securitization trust which has issued the securities to whom? To its shareholders. Now what happens in this context would be that the income of the securitization trust is fully exempt, meaning thereby there is nothing which is charged to tax so far as securitization trust is concerned. But when the securitization trust will distribute this particular income, when they are going to distribute this particular income, then at that particular point of time, the income will be completely be taxable in the hands of the unit holder, and the taxation would be done in the same manner and to the same extent as the said income would have been accessible in the hands of the securitization trust. So say for example, just giving you an example, supposedly 100 rupees is the income of the trust. Okay, now this 100 rupees is the income of the trust which is exempt in the hands of the trust. Now 50% of this income is interest, 20% is LTCG, and 30% is STCG. So 50 is interest income of the trust, 20 is LTCG, and 30 is STCG. Now supposingly I am a shareholder in that trust and I am a 10% unit holder of the trust. 10% unit holder. So I am going to receive 10. So when I am going to receive 10, I will have to ensure that I will classify this 10 into 5 rupees as IFOS interest income, and 3 rupees as STCG, and 2 rupees as LTCG under the head capital gains. This is how I am going to do the classification of this income, and that exactly how, and this amount so classified will start mingling with, will start interacting with my own income, will start interacting with my own income in that particular head. And if supposedly there may be a loss in some of the head, say IFOS, or maybe capital gains. So that loss could be adjusted from this particular classified income which I have received from the trust and classified into the appropriate head. So that is how the things will be considered so far as the securitization trust is concerned. And the most important point is that, students, whether the trust will have to deduct TDS on such payment, and the answer is yes. The TDS on such payment will have to be deducted by the trust for the simple reason that, students, why the TDS has to be deducted? Because of the fact that the entire income is now be taxable in the hands of whom? In the hands of the unit holder. And the fact that it is going to be taxed in the hands of the unit holder, therefore the trust which is making the payment will be required to deduct the TDS in this regard. The rate of TDS is very high over here, and the rate of TDS, students, you can see it is 25% if the unit holder is a resident individual or HUF, and 30% in all the remaining cases. So that is how the rate of TDS has been determined in this particular context, students. Now, apart from this, students, apart from this, if it is a non-resident, then it would be the effective rate, whatever is the applicable rate, that is how it would be considered. Now, coming to this AIF as a concept, students, be careful. In so far as the AIF as a concept is concerned, students, AIF is of three types: category 1, category 2, and category 3. Now, whatever is the special provision which is there, we are going to discuss only for AIF 1 and 2, because so far as AIF 3 is concerned, the entire income of AIF 3 is accessible only in the hands of the AIF 3. Okay, but it is AIF 1 and AIF 2 where there is a concept of pass through. Where there is a concept of pass through. But unlike in the case of securitization trust, where there was a complete pass through concept available, here in the case of AIF 1 and AIF 2, the pass through concept is only partial, and accordingly it means that some portion of the AIF1 and AIF2 income, will be taxable in the hands of the AIF itself, whereas remaining portion of the AIF1 and AIF2 income will be accessible in the hands of the unit holder in the like manner and to the same extent as it would have been accessible in the hands of the AIF1 and AIF2 if this would have been assessed in the hands of this AIF. So in this case, again, just stick with the original example. 100 rupees is the income of AIF1 or AIF2, out of which 50 is PGBP and 20 is long-term capital gains and 30 is short-term capital gains. So it is only 50 on which AIF1 and AIF2 will be taxable. Now, how it will be taxable in the hands of AIF1 and AIF2? That will depend upon the status of this AIF1 and AIF2. So if this AIF1 and AIF2 is registered as a company, then in that case the domestic company, then it is 30%, or where it has opted for 115BAA, then it is at 25.168%. But where in this context, students, the AF1 and AF2 have been incorporated as a partnership firm, then it is 30% would be the rate that would be made applicable. Okay, plus surcharge if that PGBP income exceed that threshold limit of 1 crore. Now, if the AIF is registered as a trust, then if it is registered as a trust, then this trust would be considered to be a private trust. And if it is considered as a private trust, then the rate of tax would be at 42.744%. 42.744% would be the rate of tax so far as this particular AIF is concerned. Now, as far as the remaining income, STCG income and the LTCG income of AIF1 and AIF2, they will be eligible for exemption. So they will be getting the exemption under section 10, because this two income which I have told you is going to be assessed in the hands of the unit holder. Is going to be assessed in the hands of whom? In the hands of the unit holder, students. So this is how the things will be considered, and in the hands of the unit holder, the portion of the business income that they will receive, that portion of the business income will be eligible for exemption under section 10, and it is only the remaining two income that will be accessible in their hands, in the respective head, which is capital gains, and in capital gains STCG, supposedly I am the investor, 10% in that AIF1 and AIF2, so I receive 10 out of 10, 5 is PGBP, so it is exempt under section 10, and out of the balance 5, 2 is the LTCG and 3 is the STCG. So accordingly I will be classifying respectively in the respective heads of income. So this is how the things would be considered over here. Apart from that, the other special point is, first of all, is filing of the return of income mandatory for AIF? And the answer is yes, students. It is absolutely mandatory for the AIF to file its return of income. And now, the most important in the special concept is the treatment of losses. So supposedly students, AIF1 and AIF2 has losses. Okay, now the losses could be of under various head. Now in that case, the first principle is this, that these losses which are there for AIF1 and AIF2, first they have to be adjusted at AIF level itself. First, these losses has to be set off at the AIF level itself, and if after setting off of the losses, if there is still unabsorbed portion of loss, not in the nature of business loss, then that unabsorbed portion of the loss, students, whether the pass through will it be available, and the answer is yes. So the unabsorbed portion of the loss, for that there would be a pass through that would be available, but there the pass through also of this loss in the hands of the unit holder will be subject to the condition. And what is the condition? That the unit holder is is the the unit holder has held the unit as on the last day of the previous year for a minimum period of 12 months or above. For a minimum period of how much? 12 months or above. So if the holding made by these unit holder is for less than 12 months, then that much portion of the loss other than the business loss, because business loss there is no pass through, it will only be assessed in the hands of the AF1 and AF2, and if there is still any unabsorbed portion of the business loss, then the same will be carried forward in the hands of the AF1 and AF2 itself. So in that particular context, students, when there is a loss which is there other than the business loss, so that loss, as I told you, first you need to set it off at the AIF level. And even after setting off, if there is still unabsorbed portion, and please follow the set off principle. Because if there is, say for example, AF1 and AF2 has got long term capital loss, then obviously it cannot be set off against any other income. So the set off principle has to be followed. And simply put, you are going to do a pass through of this LTCL to the unit holder. But to the extent of that unit holder who on the last day of the previous year, 31st March 2022, has not held that particular unit for more than 12 months, then in that particular case, that much portion of the loss will get lapsed. That much portion of the loss, students, will it get lapsed? And the answer is yes. It will definitely will get lapsed, students, and that exactly how the things has to be looked upon. So this is how about the carry forward of the loss to the unit holder. So the pass through is not only in respect of the income, but the pass through is also in respect of the losses, and that is what this particular concept is all about. So just keep this particular point in mind, students, and that is what this AIF as a concept is all about. Come to the next one and the big one, which is REIT. Now before we do the REIT, students, I should tell you this, that this tonnage tax scheme, the tonnage tax scheme, students, you will find in the description box one case study. One case study, as I've told you earlier in the mat also, that there is this case study which is there in the ICI. I just want all of you to go through that particular solution, and that should be all. Just try to handle that solution, because if ICI asks you anything in tonnage tax scheme, it will be directly from that particular case study itself. So just it will hardly take you 15-20 minutes, but it's worth to be done, because if that is the case, it will definitely can appear in your examination. So therefore just don't take any chances on that. Come to the REIT. Now REIT, students, is in two phases. The REIT, students, has to be discussed into two phases. The first phase that you can see over here, as I have made a particular case over here, is DLF Housing Limited, which is known as SPV, Special Purpose Vehicle, is DLF Housing Limited. It is a subsidiary company of DLF Limited, which is a holding company. DLF Limited, which is the holding company, is also known as sponsorer. And now to raise a finance, huge finance, for the purpose of high profile infrastructure projects, they will be requiring the money from the public. And how they will get it? They will then float the DLF REIT. They will then float. Who will float? DLF Limited, which is the holding company, will then float DLF REIT. And to do so, students, they will transfer the shares of the SPV, which is DLF Housing Limited. They will transfer the shares of the SPV to whom? To this REIT. and in exchange of that, REIT will give their substantial unit to whom? DLF Limited. They will then pass on the units to DLF Limited, and that exchange, students, that has taken place is not considered as a taxable transfer. That exchange of the shares against the unit of the REIT is not considered as a taxable transfer, and therefore no capital gains chargeability would be attracted. In the hands of whom? In the hands of the transferor. And who is the transferor in my example? DLF Limited. Why? Because they have transferred the shares of the SPV to receive as a consideration the unit of the REIT. So this transaction is not considered to be a taxable transfer. That is point number one. Now, supposingly subsequently DLF Limited, the holding company, they want to transfer the unit of the REIT, which is the DLF REIT. So therefore, first of all, you need to understand, to determine whether the unit of the REIT will be long term or short term, you have to consider the period of holding, which is more than 36 months. Unit of the REIT, students, be careful, it is a unit. So unit, primary students, always keep in mind this particular part. The unit, students, always would be considered for 36 months criteria, and only when the unit is held for more than 36 months, that it will be considered to be a long term capital asset, or else it will be a short term capital asset. So therefore, students, when the DLF Limited wants to transfer the unit of DLF REIT, once the DLF Limited, students, wants to transfer the unit of the DLF REIT, it needs to be very careful to know whether it would be a long term or not. Because if it is a long term, be careful here over here, whether the period of holding of the shares in the SPV, will that also be considered or clubbed with the period of holding of the unit of the REIT? Will that be clubbed or not? And the answer is yes. And by clubbing it, if the period of holding exceed 36 months, then it is long term, or else it is short term. So again, keep this particular point in mind, students, very important. And if it is a long term, then the computation will be done under the head capital gains, and that too under section 112A. 112A covers even the unit of REIT. So on the transfer of the unit of the REIT, in that particular context, the computation of the capital gains in the hands of the transferor. And who is the transferor in this case? The transferor in this case is DLF Limited. They being the transferor, whatever is the capital gains which will arise to them in this particular exchange, this particular capital gains, students, would be chargeable at the rate, as you all know, at 26 point. Uh, uh, sorry, this would be chargeable to the rate as applicable to this company, which is on the long term capital gains. What is the rate? 10%. 112A, we all know, in excess of 1 lakh, in excess of 1 lakh, students, the rate of tax that would be charged in 112A would be 10%. Isn't it? So that is how it has to be considered. For whom? For DLF Limited. So this is part A of the story of the tax implication in the hands of the transferor, which is DLF Limited in my case. So this is the tax implication. Now let's focus only on DLF REIT. Now let's try to understand at the same point of time what is the income stream, what is the income stream that they are going to have from, what is the income stream, students, that they are going to have it from what, students? From various cases. So first is the SPV. From the SPV, students, they are receiving what? From the SPV, they are receiving nothing but, be careful, students, from the SPV, students, as you can see, they are receiving in this particular case the dividend, because now they are the shareholder of the SPV. So they will receive the dividend. That is income number one. Secondly, it may so happen that DLF REIT may have given a loan to the SPV, and the SPV is paying the interest to DLF REIT. So that becomes the second category of income. So let's first try to discuss what is the tax implication. First of all, both the income, that is the interest income received from the SPV and the dividend income received from the SPV. So both these income, students, are not taxable in the hands of whom? Both these incomes are not taxable in the hands of the REIT, but there is a pass-through concept which is done, and the pass-through is done in the hands of the unit holder, and it is a unit holder who will then be recognizing this amount as the income under the respective head, and accordingly they shall assess their own total income in that particular way. So the first particular point, students, is the interest income received from the SPV or the dividend income received from the SPV that is not at all taxable in the hands of DLF REIT. Whatever taxability occurs will happen only in the hands of the unit holder. Now, student, there is one very peculiar and important point over here is about the fact which I was telling to you some time back in the non-resident taxation when we were doing about the MAT. At that time, I told you about this concept. I am repeating this point again. Dividend, we all know it is not going to be accessible in the hands of the SPV, in the hands of the REIT, but shall be accessible in the hands of the SPV. But shall be accessible in whose hands? In the hands of the SPV, students. Now, the fact that it is accessible in the hands of the SPV, primarily students, the fact that it is accessible in the hands of the SPV, sorry, in the hands of the unit holder, there is one case where even the dividend income which is received by the unit holder via the REIT, that dividend income is exempt in the hands of the unit holder. Now, which is that particular case where this dividend income is also exempt? I'm using the word also. Also, why? Because it is not accessible in the hands of this particular REIT. It is not accessible in the hands of the REIT. So, therefore, this dividend income in one particular case is also exempt in the hands of the unit holder, and that case would be when the SPV has offered its income at the normal rate of tax. So, if the SPV has offered its income at the normal rate of tax, which is say 30%, then in that particular case, a higher rate of tax is what is paid by the SPV, resulting into a lower amount of dividend distribution. And because it is a lower amount of distribution, therefore a full amount of this particular, a full amount, students, in this particular context of the dividend income received by the unit holder will be eligible for exemption even in the hands of the even in the hands of the unit holder, which is receiving the dividend via the REIT. But if you say that no, sir, this particular income which I have received from the SPV, this particular income which I have received from the SPV is in the nature of, if supposingly SPV, let's look upon this, if the SPV has opted for 115BAA, meaning thereby on its profit it has paid the tax at the rate of 25.168%. On the profit it has paid the tax at the rate of 25.168%, and on the profit if it has paid the tax at 25.168%, it implies lower amount of tax has been paid by the SPV. Lower amount of tax has been paid by the SPV, and if it is a lower amount of tax which is paid by the SPV, meaning thereby higher distribution of profit. So if it is a higher distribution of profit, then let the shareholder now pay the tax on this particular dividend income. Let this particular shareholder now pay the tax on this particular dividend income. Now, at what rate, students, this particular tax would be chargeable in the hands of the unit holder? So that, as I've already discussed with all of you, if the unit holder is a non-resident or a foreign company, then the applicable tax rate happens to be 10%. Applicable tax rate happens to be the 10%, and as I can extend that now, that this particular dividend income received by a non-resident or a foreign company unit holder from the SPV, which has not been which has subject to 115BAA, then in that case this dividend income in the hands of the non-resident or the foreign company is going to be assessed only at the rate of 10%. And because it is accessible only at the rate of 10%, in computing the book profit, even this income, dividend income, which is accessible at the rate of 10%, will not form part of the book profit. Will not form part of the book profit. Is that clear to all of you? Many students are saying, sir, what about the rate of tax in the hands of the unit holder who is a resident? So, see, students, for the resident, as you all are aware, in the dividend taxation also we have discussed this particular point. There is no special rate of tax at all for dividend taxation in the hands of the shareholder, unless it is a dividend of 115BBD, which is in respect of the foreign company from which the domestic company receives what, the foreign company in which the domestic company students in this particular context students, are receiving uh, students the dividend income, and that foreign company in which I have 26% or above voting power, then the dividend income will be assessed at the special rate of tax. At the special rate of tax. Isn't it? The dividend income will be assessable at the special rate of tax, students, as you all are aware. So there is only this category of special rate of tax which is available. Apart from that, there is no special rate of tax. So therefore, if it is a resident who has earned the dividend income via the REIT and the SPV has opted for 115BAA, then the rate of tax would be that as applicable to the person. As applicable to the person, students. So this is one of the point that you should always keep in mind, bear in mind, students, in this context of the dividend taxability. Okay, just hold on. The REIT, let's discuss about the other income stream of the REIT. So the other income stream of the REIT would be that they would have done massive investment in the various infrastructure project. Now, if they have done a massive investment in the various infrastructure project, then in that particular case, students, we will say what? That the SPV will be then in receipt of the rent. They will get lease charges or rent as the case may be. Then such rent or lease charges so received by the SPV, so received in this particular context by the REIT, again that rent income is not accessible in the hands of the REIT, but the pass-through status would be made available. That is to say, it will be taxable in the hands of the unit holder. It will be taxable in the hands of the unit holder. Many students are wondering, sir, if everything is taxable in the hands of the unit holder, then what will be taxed in the hands of the REIT? That we will see, students. But right now, just stick to this one. The rental income received by the REIT will be accessible in the hands of the unit holder. Will be accessible in the hands of the unit holder. Now, under which head this particular rental income will be classified? Obviously, it has to be PGBP. And why is it is PGBP, students? Also, for that you need the answer. The students herein always keep in mind this particular point, that there is a case law of Chennai Properties and Investment Limited, where the leasing of the house property is your business. Then the income arising from such activity, students, will be chargeable under the head PGBP. Under the head PGBP, students. So the rental income pass through is available, yes. So it will not be assessed in the hands of the REIT, but will be assessed in the hands of the unit holder. Okay, so that is how the things will be considered over here in this context. So that is for the rental income. Now coming to, so therefore if this will be a business income, students, for the unit holder, because in the hands of the REIT, this particular income, if this would have been accessible, this particular income, if this would have been accessible, would be accessible at the rate of, say students quickly, not at the rate of, will be accessible in the hands of PGBP, under their PGBP, not at the rate, but in the hands of PGBP. So similar would also be the classification that needs to be done of the pro rata share by the unit holders. Now, which is that income, therefore, which is taxable in the hands of the REIT? Only one income, and that is the other income. Other income meaning thereby, supposingly, in this context, there is a long-term capital gains earned by the this one, your REIT. So, if there is a long-term capital gains which has been earned, so what will happen, students, in this context? What will happen? It will be taxed at the, it is an other income. So it is neither an income received from the SPV nor it is in the nature of rental income, and therefore we will categorize this as the other income. And on the other income, students, as you all are aware, you will first check out if there is any special rate of tax that is applicable. If there is any special rate of tax, then on the other income, the trust REIT will be accessible as per the normal income. Okay, and depending upon the fact that if there is any special rate of tax, then that income in the hands of REIT would be accessible at the respective rate of tax. Students. Okay. And whereas if it is not a special income, the other income is not a special income, then fine, go ahead and do the MMR, because then it is after all REIT. And if it is an REIT, it is a business trust. It is a private trust in a way. And because it is a business trust or a private trust in a way, therefore, if this other income is not in the nature of a special income on which there is a special rate of tax that is applicable, then in that particular context, students, we will say that the other income will be taxable at MMR, which is 42.744%. So only this income which has been distributed by the REIT is assessable in the hands of the REIT at what rate I have already told you. Balance all the other income which is there, namely, but you have to be very specific, namely the interest income and the dividend income which is there paid by this particular person, the the income from the SPV, namely in the form of interest from the SPV and the dividend from the SPV. So these particular income, students, which are being there are only to be assessed in the hands of whom? In the hands of the unit holder, with one exception where even the unit holder will be eligible to claim the exemption in respect of the dividend, and that can happen only if this particular only if, students, the SPV has not taken the concessional tax rate of 115 BAA. And the next, where the income is received by the business trust directly, so it is through the direct investment that they are getting the lease charges, or for that matter, students, in this context, so therefore this lease charges would be classified under the salary, under the PGBP. And thereafter, students, the next particular point which is there, which is of the other income. Other income, if it is chargeable at the special rate of tax, then special rate of tax. And in respect of the balance, students, the other income will be taxable at what rate, students? The other income, students, will be taxable at what rate, students, in this particular case? At the MMR rate that is would be applicable, and this other income will be assessed in the hands of the REIT. So let me take you through this example. 100 is the income of the REIT, and it comprises, students, of the SPV, in this context. Sorry, let me in fact take you through this one. Supposingly 10 rupees is what has been distributed to me as a unit holder. 10 rupees is what has been distributed to me as a unit holder. So being a unit holder, students, now in this case, being a unit holder in this case, so the proportion of the amount, say the rental income proportion in this 10 which I have received is say 50%. So it will mean that out of 10, 5 is going to be assessable or taxable in my hands, because it's like a business income. But what about in this case, say for example, other income? So if in 10, supposingly, students, if it is a rent which is 50, other income is say 2, and from the SPV, considering interest and dividend, it is say 3. So what will happen would be that, students, the out of 10, as I told you, 50% is about this rental income. So 5 would be classified in my hands under that PGBP. 5 would be classified in my hands under that PGBP, and the remaining in this context, students, remaining other income, say it is say 2. So the 2 on that the trust was assessable, and because the trust was assessable on that 2, accordingly it is exempt in my hands. And the last but not the least is this particular interest income received from the SPV, or for that matter the dividend income received from the SPV. So the positioning, students, that will be there would be that the same would only be taxed in the hands of whom? In the hands of the unit holder. The proportion of the pro rata would have been given. So this is what, students, is there so far as your REIT is concerned. So this covers up your entire REIT concept, students, in this context. With that, as I told you, students, tonnage tax scheme, you will refer it from the link which I have given it to you immediately, students. Please do it once. Maybe it can so happen that on the day of the examination you may not be in a position to revise it, but since you have seen the question, and if similar question is what appears in the examination, then it is all for grabbing, students. All for grabbing. So, students, with this, we are done with this MAT and the surrogate taxes, students. The MAT and the surrogate taxes, students, that much is sufficient. So therefore, now then, students, in this context, students, allow me, students, just 2 minutes. So students, with this we are done with this particular part now. I think we are done with this entire segment itself. So that is it, students. Now on 2nd of May, I'm going to put across the 2 hours of the case law in the YouTube channel itself. Same YouTube channel. I'm just going to put across this case law, which you all have to go through it mandatorily. Absolutely a mandatory event for all of you to go through the case law segment without fail. So that 2 hours is what I'm going to deal with it, and that is what we are going to trade off that case law, which is something which comes for around 6 to 8 marks in the examination. So don't take any chance. And thereafter, students, I'm also planning for some last day revision videos for all of you, so as to expedite on the difficult topics, so that you don't get stuck unnecessarily on these particular areas. So that is also what is on the cards for the LDR videos. So that is what I'm going to deal with it. So students, that is what it is now. So that is done now, and accordingly now, students, I'll see you maybe in the next video. So this quick announcement, students, about the Unacademy flagship program, students, which you all are aware herein. So in the Unacademy, one subscription, multiple benefit. Which is the multiple benefit? Through a subscription plan in this platform. Live interactive lectures are there. Unlimited record lectures are kept in our bank. Multiple educators for all the subjects, dot solving session, and the practice of the mock test series. So far as CA final group 2 is concerned, students, the subscription starts from say 3 months and it goes to 36 months. So for example, if some of your friends are having their attempt due say November, and they may have to cover only say a subject or so, then it is 3 month subscription which they can go for it. But again, I'm repeating, the code that they need to put, the referral code that they will have to put, please do tell them about CADS, and that will give them this discount on their subscription plan. Direct tax paper, students, is already completed, means they have the full direct tax. They can do the recording, they can complete the entire comprehensive lectures which I have already done of around 225 hours. So they will get that level of grip on the subject. 6 month subscription is also there, ideal for those students who have got to cover multiple papers in the particular group. So for them, 6 months is advisable. But one thing will remain constant would be this code CADS, because on which you get 20% discount. May 23, November 23, students, for them 12-month subscription is what is advisable, and that is what will be giving them the exclusive access to the entire group for which they are taking up the subscription. Combo offer, students, is also there in this regard. And those who wants to go with the iconic plan, iconic subscription, students, is the subscription whereby we are giving the students the textbooks and all. There is a round the clock the dot solvers, the mentors are being provided. Thereafter, students, there is a evaluated test series program which is also there in the case of that. So these makes this features always very impeccable. So this is what it is for iconic. However, students, starts for 12 months. So any of your friends or so who have got their attempt due in May 23 or November 23, for them, students, iconic plan is the best plan with all these loaded features which are there, which I have told you in this regard. Same thing, students, in this context, plus in this context, students. So this is what is about the Unacademic subscription plan. Please do refer to your friends, juniors in your office to take the benefit of the subscription, so as to get the maximum out of this particular platform. So students, with this, I'll end up my session, and I'll see you in my next video on this particular YouTube channel. Take care. Bye.